This is your last margin call with your host, Beck and Tim.
It's another midweek video, and midweek videos call for midweek drinks as always. So what we have here is Decadent Ales Pineapple Whip. It is super great in terms of flavor, and ABV on there is a little bit above 8, so it's about 16 ounces, whatever it rolls around to, and it's just a great drink to have overall for how we're going to start off this video. Just a quick recap of the ones that we did for the part 1 video. If you're just tuning in for part 2, we did Google, Disney, Snap, Ford, Gilead, and so far we nailed Google, nailed Disney so far. Snap should be great. I don't see that turning around and sprinting past 20, so that one should collect. Ford, whatever. It's 22 cents or 22 bucks on that. Gilead is going to take a little bit of time to play out because of its May expiration that's on there. So we're shooting pretty great for this week, and I'm pretty excited how things are turning out. It's just going to be all about, can we get the make sure that the losses aren't greater than the wins, and so that we kind of get screwed over by just one simple play. So we're going to dive into week part 2, which is QCOM. Peloton, which should be fun and exciting for everybody, and I wanted to have a little bit of fun with that, so I'll go into more detail when we get around to that. FEYE, Twitter, Activision, and ABBV, another healthcare company. So people really enjoyed the speed and quickness of the last video, so I am going to be talking as fast as I possibly can. Quick macro side of things on what I possibly know or don't know about things, hit the plays, and then get on and move out to the next one. So first one, we have QCOM, which is going to be part of the semiconductor sector. Everyone's hype about semiconductors moving forward. I don't really know much about this, so and I can't really say, oh yeah, sales are going to be great and this is going to be there. So I kind of just rolling with the chart here and seeing what we can play out. And I put up on here the white lines on these charts are going to be the implied move. If you ever think, oh, why does he have those lines there? It's just to show you where the implied move for that week is. And as always, the IV percentile chart of what you should be looking for and playing doesn't mean you necessarily have to follow it. It just means those kind of favor you in what you should do. But the first one is a 94 call calendar when it comes to this. So you put on the call calendar, you're going to be selling this week, buying next week for that 94. Gives you a pretty big range of 86 to 104 on there. And remember, with the call calendar, excuse me, is this a call calendar? Yes, sorry, I thought it was put calendar for a second. So when it comes to this, you want it to not go above 94 this week. And then you want it to kind of come back, take a little like breathing room after the pop, and then continue on next week if you're going to hold and play out, or you can just take off whatever it gives you, but obviously you're not going to get that full amount the first week. And then the other one that we have is going to be the Iron Condor. Again, selling premium during these times are great because it's taking advantage of the sucker's bet that we have out there. The only downside is if it makes these giant moves, you get the giant losses. So quick and easy one, an 82 put, 84 put all this week, and then you're going to be doing the 95, 97 call. Obviously you're selling the ones that are closer in together, so the 84, and then you're going to be selling the 95, and then you're going to be buying the outside ones for protection. You're going to be getting 63 cents off this if you were to enter it. Obviously fluctuations in pricing due to whenever you listen to this video, or maybe the market goes a little bit crazy down, up, and before, but the risk reward ratio is still there in terms of maybe if you get 1 to 3, 1 to 2, or whatever your ratio comes out to be. So 63 cents to the what you'll be collecting if it stays within there, and a 137 to the downside. It's pretty, I think that's pretty solid. You're risking, you could lose double what you're making, but that's what you get for an Iron Condor essentially. It's pretty simple. And then we're going to moving on to Peloton, which is Peloton. I wanted to kind of make sure I have time to talk about this. It's the meme stock. It's a freaking exercise bike with an iPad attached to it. And they sell these services like Insanity and all these things. And yeah, it's a workout craze. It won't last. It just won't. It never does. Workout crazes stall for a reason. That's why no one hears about P90X anymore. No one hears about Insanity anymore. No one hears about Julie or whatever her name is, it's stupid. The whole thing is stupid. And if you bought one, you're probably stupid too when it comes to this. So how do we take advantage of these stupid things when they come on here? Everybody thinks that this is going to explode. It's like kind of trying to find the evaluation for this company for the popularity that it has at the time. So the IV is going to be jacked through the roof when it comes to this. And I think it was 73 percentile currently trading, and then this week is just being a little bit wild as it is. So when it's during those times, you're going to be looking to sell straddle strangles, or wide iron butterflies when it comes to that. And just make sure that you understand that everything is capped too. We're not doing open exposure. Sure, we could just sell a call, but sell a put or anything like that and just kind of ride and collect that, but we don't want open exposure to anything, and everything will be capped. That's why some strategies are limited when it comes to this, because you can always leave something uncapped and grab like a jade lizard, and then kind of benefit a little bit more off of that. And so that's why you kind of get you hear the same 8 types of styles that are played, and you can kind of manipulate them a little bit, make them look a little different, but it's the same style. So when we dive into this, it's going to be an iron condor number 1, simply because you want to collect that, because the IV is high, and so if it doesn't make that move, it's going to crush that right down. It's the simplest terms you can simplest way you can kind of view it, instead of trying to actually find out what it means, how it works, and doing all that. And to put on this iron condor that we had, it's the 27, 29 puts. And then you're going to be doing the 40, 42 calls on that. You're going to be collecting 60 as long as it stays above 28.50, and as long as it stays below 40.50. And so that's a big range on that. It's a good move. You're going to risk, if it goes beyond that, $140, which isn't that much, and you're going to be making 60 as long as it stays in there. Most likely I'm going to be putting on that one, and when it comes to this, or I'm going to be doing on the next one that I have, which has been a little bit of a favorite of mine recently. It's been a double diagonal when it comes to this. Obviously there's fluctuations within this, and when you put on a double diagonal, you need to think of it in terms of you are going to be selling a strangle, so it's going to be locked into those prices. You're going to be selling this week, which means that you don't want it to breach those, or you could start losing a little bit. So as long as it doesn't breach those, you're collecting that. All right, and then you're going to be buying a strangle for next week. All right, so then you want it to go beyond that, and that's how those two works, and then that's how you get the 2 profit spikes essentially. So when it comes to this, so to put this on a double diagonal, all right, you're going to be setting up 2 or 4 things total. All right, and so the first diagonal you're going to be buying, and to break this down really simple and easy, is you're going to be selling the 29 this week, and then you're going to be buying the 28.5 for next week. You're going to be selling the 37.5 call this week, and you're going to be buying the 38 call next week, and it's going to look like the Batman helmet. All right, so that's your 2 profit spikes, 2 profit tumors, profit mountains. You see them called a lot of different things. Max on this is going to be 105. I love that. And look at the range that it gives you on that. At 26 all the way down, 42. As this play progresses, that contracts a bit as well, just because based on the changes as well, and you being long on the outside. Otherwise, you're not just collecting that. But you're probably going to be looking within that 28 to 40 range where you want it to play off of, and then you just collect that. This profit on that is going to be 150 for one spike, 200 for the other spike. Probably drops down to the 100 to a little bit of over 100 for the other one to the upside. But I think that's a great way to strangle the shit out of that this week, and then kind of strangle it next week in case it maybe did get moving. And then you can always micromanage it a little bit, and kind of leg out of these things in case you need to readjust it and just put on one diagonal separately instead of the other. All right, and then the other one is going to be FEYE. All right, so FEYE. That's going to be reporting a little bit low in terms of the typical stocks that we deal with, the $16. You're not really going to be collecting much running, iron condors. You can run calendars and diagonals for these to try to collect money. But if it's going to go up, you can run a 17 put calendar. But if you think it's going to stall out and come back down, there's just not much you can really do with these low stocks. So you know, sometimes simply just buying outright is going to be the best option right here. And so I just had to think, you know, like, okay, what can I do? I have the 200-day for investors right there hanging low. Maybe it continues up. All right, so why not just we'll do front month of the February 21st, 17 calls for 45 cents. You know, that gives you a couple weeks for it to play out. It plays off in the implied move, which I think is $1.25. So even at $1.25, all right, you're at 17.25. You're almost at break even already if it hits the implied move to the upside. All right. But there's not much more you can really do with this. You know, like, there's not too many strategies that you can have that take advantage of this and that are capped. All right. So you kind of just have to pick a direction. Maybe if you're bearish, you get something that, you know, where it maybe stalls out on the, you know, maybe you grab a butterfly at the 1550s or something, because maybe you think you're a little bit bearish, but it stalls out at that 200-day. So that's a different option that you can play on it. Twitter is another one. So TWTR. Again, the white lines are the implied move that it has, and one of the implied moves happens to line up with the 200-day as well. And then you have the down to 30 for this one, up to 36, so $6 range that you have on that. The implied volatility percentile that we have on this is going to be 66. With the we'll just call it a $4 move, just in case things get moving like they did with Facebook, all these social media sites. Maybe kind of taking that into consideration. One of them that we came up with, again, it's always making sure that things are capped. There's a lot of things that we can leave uncapped and we don't, so we came up with a broken wing butterfly. It's a bullish broken wing butterfly, meaning that it can come down a little bit, but you kind of expect it to keep up with trend and continue forward, but you don't really know enough to kind of make sure that continue, you know, need to leave that the unlimited potential on that, like doing like a back ratio, something where you could just have it stall out. If it stalls out here, then you lose the maximum, but if you don't, then, you know, you're capped to the downside. But those are the types of plays that you could have. So we went with you know what you're going to get when it comes to this type play. That's the best way to put it. And to put this on, you have your 3150 put, 33 put, 33.5 for 34 credit on that. All right, and your downside is 66, and that's if it drops below 32. But if it comes back, like maybe just the market pulls it back for some reason, or it does bad or whatever, you know, between 32 and 33.50, you know, you're going to get a little spike. Probably around 75, I want to say, is what it was at. That's how I remember it. Yeah. And then if it just goes up in general, you make $34 off it. So nothing to write home about, but, you know, you're trying to increase your odds by, you got to stall out. Doesn't matter. You make money. You got a little dip. You make money. You make the most money you can. And then if it goes up, you know what, you make $34 and continue forward, instead of being completely one directional and be like 40 calls. Let's see what happens. And rolling with that. All right, this isn't going to be Tesla, so, you know, you kind of just have to just accept what you can get, and you don't know what directions unless you got inside information or other types of things. So we'll just roll with what you got. And then we have Activision, which is going to be the next one. I'm trying to really beat time on here on this 13 minutes that we have going into so far. The implied move is going to be 64 to the upside, 55 to the downside. You know, they haven't really released a game yet for any of this. In a while, and I think Overwatch is dying. It's not really doing as well. I know a lot of people are pulling their licensing with them a little bit. It's just not doing really well. And, you know, Diablo isn't coming out for a while. World of Warcraft just had some problems that could, you know, maybe affect sales on its release, but I don't know if that's included. They had the Vanilla WoW come out. I'm not sure the numbers on that, so can't really tell you, but I'm just not too overly bearish on it or bullish on it. So you kind of have to play into that a little bit and maybe allow your bias to kind of allow a little bit of upside. And when we did that, we came up with the 62 calendar on this. So, you know, all this week you're going to be selling the 62. We went with a put, I believe, right? And we went with a call calendar, didn't we? Okay, so call calendar is going to be on there, meaning that we want to sell that and we don't want it to go above 62, so we allow it for a little bit of upside, because maybe the guidance is great because they got a bunch of games that are coming out and allows that pop, that the consolidation that it's really been having. And also you can micromanage that and get the heck out of there the second it opens if they did really well, and just ride that 62 call up for next week as well. All right, and that's the kind of how you play those calendars, is, you know, you take advantage of it, but you think, okay, well, it's been locked down for so long, and maybe it just has a lot of pent up movement that just wants to get going, and that's why you not protect yourself, but you have that exposure to the upside as well for next week. And then the other one we have is the typical, if this just continues to play within that range that it just keeps stalling for, I think it's been like years at this point, it feels like, but I think it's only been like a year. And so you lock it in, all right, with the iron condor on this, and you grab the 54 put, 56 put, and you grab the 64 call and the 66 call for 52 credit on that, and you're getting a max downside of 150. I think it's like 148 to be exact. And that's only if it, you know, you get that downside if it hits 65, and then you hit that max when it goes down below 55. So it gives you a pretty good range on that, especially for something that's been so range locked. Maybe just going along with it and maybe trying to protect yourself. You can maybe do a broken wing iron condor, that one that favors a bullish side as well, if you're bullish on that, but you don't want to lose as much in case it does break out. You can kind of cut your losses almost in half by kind of stretching out the call side or put side on that, depending on which side you do as well. So those are the two plays that we have. I'm allowing some upside, but I'm still thinking downside, just because there's nothing really special coming on for the Activision right now. Maybe they got something going on later, but we'll hear in the conference call and whatever they do. And then the last one that we have is going to be ABBV, another bioscience, healthcare side of everything that's going on. You just look at the implied move that it has right now. I think it's like 6 or something. Maybe we'll just call it 6 for giggles right now. Currently at 84, so probably looking at 90 to the upside, and you're probably looking at about 80 to the downside. In terms of the implied move, not saying that it's going to get locked in there, all right? But with healthcare, and if you look at the kind of like an hourly chart that's on this, and I know technicals don't matter when it comes to actual plays themselves, and because it doesn't tell you anything, but you know, you have what could be, even if it dips a little bit, it could be the formation of a right shoulder on an inverse head and shoulders. So even if it dips down a bit, and then it kind of continues up after it just had this massive run up after a like 3-year long downtrend. So it's going to have that pullback, and it's not necessarily a pullback maybe all the way to the 200-day. So what I thought about doing on this was, again, another back ratio when it comes to these healthcare names, because I think a lot of it plays into the Bernie Sanders side of things of, you know, if he's not winning Iowa, maybe he's not going to get the vote, and, you know, Bernie's hard on healthcare, so he's going to rip them apart. But Pete came out here, and he's leading, and, you know, he's not all technically there for this healthcare for all stuff. He has his own little twist on it, I believe, so don't quote me on that. So maybe that's why you can see a quick rebound in healthcare and continuing forward, especially if it's going to be Pete versus Trump in the election. That allows a couple more months to play out and let them do their thing. So running another back ratio on this. May has been the target, and you're going to be doing the 87.50, and then the 90 calls on that as well for May. And you're going to, you know, if you don't know how to put that on, you know, I always have it up there as well on the screen. You're going to be selling that 87.50 and then buying 2 of the 90. So it's going to be a dip if it stalls out there when you get to May, and it's still there is when you're going to have your hardest loss, but you need that collateral of like 350 or something to run them. Yeah, 350. And then it just allows for a limited upside on that, and especially for something that's been locked up for 3 years in a downtrend and just broke out. Maybe it continues on and you want that exposure. It takes $1.05 or to put on, you know. I think that's great exposure to it, and it could really benefit you, especially for when it comes to the geopolitical side of things, the macro side of things, and technical wise. So that's why I've been running back ratios and having the mindset of back ratios when it comes to healthcare names. And then if you just had to, you know, had to play something this week, I think what I came up with was just a butterfly. Since it's reporting on Friday, you kind of have to get in this early. in order to actually make money off of it. The only downside is that the downside is kind of big. And again, it plays off of that thing where even if there's a small pullback on the hourly, it could stall out there and then kind of reach towards that hourly inverse head and shoulders. So that's why that's why I set this up the way I did, where it's a broken wing butterfly when it comes to this, and you're going to be buying the 79 put, you're going to be selling 2 of the 82 puts, and then you're going to be buying an 83, and it gives this broken wing aspect of it. All right, it's 26 credit. The downside on this is huge. It's absolutely huge. All right, so this is it's not a good risk to reward ratio, but it plays off the bias that I have. And frankly, since it's Friday, there's not really great plays out there for it. Collecting premium kind of really sucks on it. And you're collecting like $20 and you're possibly like risking, losing 150 or 170 or something was on that. So it's not great. And so this is the best thing I can come up with, is allow for some stalling, a little bit of a drop, and then just collecting whatever you can on a Friday ER of $26 if it goes up. So those are our plays. I'm hoping that we'll get a better percentage going this week than we did last week, and so far we've really been hitting it with the first video. That should boost the numbers. So let's see how this one rolls out, and then we'll see what happens on next week. I think a lot of names are starting to kind of dwindle down, and you're not going to really get the big names like you did before. So we'll see how that goes. And again, if I have any adjustments to the plays, if I change and enter plays that are not been called out or anything like that, follow it on Twitter, Messiah Theories. I have been adjusting a few of them plays that I did from the previous video, or ones that I got filled on. It doesn't mean that they don't work still. It's just I found it just based off the price action that what I wanted to do itself. So we will see you guys next week, and we'll continue this going on week 5 of our ER series. All right, have a good night, everyone.